Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and this is it. On Friday, Jerome Powell, who is the chair of the US Federal Reserve, announced that the Fed will adjust their interest rate policy as they are confident that thanks to what they've done, inflation is returning to 2% and they can shift their focus to supporting the cooling labor market, which, after a 30% downward revision in jobs created over the last 12 months, clearly shows us that the strong US jobs market was nothing more than a mirage at best, and at worst, a major misinformation campaign perpetrated by the mainstream media in an attempt to sell a story we all knew wasn't true for reasons I'm not going to get into in this video. Now, before we start covering gold, silver, and the stock market, because that is the focus of this video, let me first suggest to Mr. Powell, if by the off chance he is watching this video, that instead of declaring victory thanks to the Fed's fantastic monetary policy, it might be more fitting to wave the white flag of surrender, because what we've gotten since 2022 is no less than two banking crises, a stealth bank bailout program, rising unemployment, most likely with more increases on the way as 818,000 jobs just got wiped off of the records. And what does the Fed have to show for this? Inflation, as measured by the heavy manipulated CPI, is still 45% higher than their 2% target. Those are the facts. The Fed hasn't been victorious against anything. Once again, they have simply made things worse, not only for Americans, but for people around the world who have to live with the consequences of their decisions due to the fact that the US dollar is still the global reserve currency. So with my bashing of the Federal Reserve done, I want to cover the consequences and opportunities we're going to see in the coming 12 to 36 months, and I'm going to start from the impact of the Fed's decision to lower rates and why it's a major sign that big changes are coming for the US dollar, stock prices, as well as gold and silver prices, and I'll also say a word on how I have shifted my gold and silver purchasing strategy as a result. Once we've covered that, I want to talk about the volatility I think we could see for gold and silver in between now and when we hit $3,000 gold and $40 silver, which were targets I said we could see in 2025. And I want to finish this video by answering a great viewer question on the topic of central bank gold buying and address what risks exist for gold stackers and investors if central banks decide to start selling their gold and what the odds of that happening are. So let's kick this off by looking at the first direct consequence of the Fed's policy shift, and that is a weakening US dollar. Now, I first pointed this out in a video in 2022 when the US dollar index peaked. And what I said then was the US dollar is artificially strong versus other global currencies due to rising interest rates, which were on the way up in 2022. And this drove demand for US dollars and US debt up because it became a more attractive place to park money relative to other places in the market, like Japan, for example, which kept interest rates at 0%. In fact, at this time, they were still negative. Because if I can get 5% on a US dollar bond versus 0% on a Japanese yen bond, the choice is simple. And this is why you hear stories of people borrowing money from Japan to invest in the USA. So I hope you're following me so far. Now, with rates ready to come down again, the opposite is happening. And as I said back in 2022, it's only a matter of time until the dollar index comes back to its average level, which is closer to 95 than above 100, which is where it has been over the last couple years, with the potential to go lower, depending on how much money printing and rate cutting the economy will need to get it moving again. And the bearish technical patterns we're seeing in the charts support this macro outlook, as well as what I've said about this pushing the prices of gold and silver up. Because what a weaker dollar means for real world assets that are priced in US dollars, like gold, is that As the dollar declines in value, they go up, and you can clearly see that divergence happening for gold compared to the US dollar, which started in February of this year when gold broke the $2,100 per ounce mark on a weakening US dollar linked to rate cut expectations. And this is now accelerating as we have confirmation that those cuts are coming in September, which has driven the price of gold even higher, and it's now in its second straight week with a close above $2,500 an ounce. But gold isn't the only thing that is benefiting from the devaluation of the US dollar relative to other currencies, because it has also bolstered silver, large companies in the S&P 500 index, as well as smaller companies listed on the Russell 2000 index, something that was expected and will likely carry on at least another 2 or 3 months until the economic realities that triggered the rate cuts start to settle in. Because with inflation still much higher than the 2% target, the Fed isn't cutting because they genuinely think it's the right thing to do or that they've actually beaten inflation. Rates are coming down because of how much the economy is slowing, and the Fed thinks that if they cut rates early enough, they can inflate the bubble again and avoid some kind of economic hardship. And they thought the same thing in July 2007 when interest rates were cut on a backdrop of rising mortgage delinquencies and defaults. And although those early cuts, those July cuts in 2007 led to a 9% bounce in the S&P 500 and a new all-time high for the index, something we're kind of seeing play out right now, by the way, ultimately, it couldn't prevent the inevitable pullback, which ended up being a more than 50% drop in the S&P 500 from late 2007 moving into 2009. So this is a lesson on just that. Yes, the market is celebrating right now because rates are coming down. This is what they wanted. But if my analysis is correct, the S&P 500's fair price is closer to the high 3,000s as opposed to the mid 5,000s where we're at today, as I showed you a couple weeks ago. So keep that in mind when you see the mainstream media rejoicing at new records for the stock market. Now, moving to metals, although they are fundamentally strong right now, a broad sell-off in the market can create enough panic to temporarily bring prices down. And we got a taste of that on Monday, August 5th, when the market crashed because the Bank of Japan said interest rates shouldn't be 0% anymore. And this is something I've been meaning to cover in recent videos, but kept putting it off for one reason or another. But I saw a great video on Friday from my good friend 2is1, who offered his thoughts on the topic, and I will link up his video in the video description below. But I have to say that he did a great job in that video, because too few YouTubers in gold and silver are brave enough to take a stance on anything unless it's promising unrealistic price targets for silver. But what 2is1 said is that he expects the price of gold to run up higher, followed by a pullback, followed by another big run up. And I agree with his take, meaning I expect gold to make a move up, a new move up to higher levels around Q4 of this year. And I've spoken about that in recent videos, and potentially sell off a bit with the stock market at some point in 2025, with the only difference in our points of view being the numbers we're going to hit. Because in my opinion, and my Patreon members will recognize these numbers, for gold, I revised my 2024 price targets, and we now have a range between $2,496 and $2,764 per ounce as an end-of-year target. And I revised these numbers back in June versus my $2,400 per ounce target that I presented here on YouTube in December of 2023. Now, taking those numbers, when we factor in a crash, if we look at what happened in 2008, which, by the way, the low price of the crash did not go lower than the pre-interest rate cut levels for gold. And I marked that level with the blue line here on the screen, so be aware of that. Anyhow, in that crash, gold came down by 28%. But that was in an environment where central banks weren't buyers of gold, which makes a big difference, because today, or at least in 2023, they accounted for more than 20% of gold purchases. And that's gold we can safely say isn't going to be making its way back onto the market anytime soon. And I'll talk more about that when I cover this video's viewer question. That said, Because of that assumption, we have to decrease the size of the pullback that we should assume for gold this time around if we see a broader market sell-off. In addition to that, because I expect the overall market pullback to be softer in 2025 and 2026 than it was in 2008, and I mentioned those numbers earlier, I expect a roughly 30% correction in the stock market this time around versus a 54% correction in the stock market we saw in 2008 and 2009. Now, what that means is my estimated pullback for gold in a market crash is about 20%. And there are factors that support the case for an even shallower pullback than that, like changes in the laws surrounding what banks can borrow against. Those are collateral laws. I've spoken about them in past videos, but I'm not going to get into this video. But if we're looking at the worst case scenario, let's really make it a worst case scenario. Let's talk about a 20% pullback. And that means if my 2024 targets hit and we get a correction from that range, it might be higher, by the way, but let's be conservative with the numbers. The pullback I see for gold is a possible return to $1,997 per ounce to $2,211 an ounce, with a key technical support level being the $2,167 per ounce level, which is the October 2023 breakout level, a point in time which I told you to purchase gold. If you remember, I said that gold was going to break out to above $2,300 an ounce back in October, and we were at that level when I said that was going to happen. And in my opinion, when gold crashes, that is likely the level it is going to pull back to. It's going to, as maybe Gareth Soloway sometimes says on his channel, retrace, go back to the scene of the crime, as he likes to say. And I still see, of course, a remote possibility that you have to keep in mind that gold does have a maximum downside around that $2,000 level. But from my point of view, I don't see it going lower than that. Applying that same logic to silver, which crashed 54% in 2008 before going up to nearly $50 an ounce, if we account for additional industrial and jewelry demand, which didn't exist at the same level in 2008, as well as some of the new banking laws that should diminish the role bullion banks played in the 2008 metals crash, from my revised 2024 price target range between $32.61 an ounce and $35.54 per ounce for silver by the end of the year, we may see a pullback of 38%, which in my opinion brings us back to the key technical level of $22 an ounce. And I know that might be painful for some of you to hear, but it is a possibility, and I have to be honest when I'm breaking down the numbers on this channel and flag this as a risk so you're ready to deal with it in case it happens. Now, this $22 per ounce level is a strong support level for silver that goes back to 2023 before the most recent price breakout. And although I can't say for sure that we're going to see these prices, what I can say is that if we do see them, and again, this is just kind of another warning for you, I highly doubt that you're going to be able to buy these bottoms, as they may end up being quick bounces off of technical levels triggered by computer buying and selling of paper metals. So if you're new to the game, that's something you need to know when watching these videos and hearing my technical and macro analysis breakdown. Because as fun as it is to look at these projections going out to 2026 of how I expect metals to significantly appreciate versus the stock market, we have to be ready for volatility in between now and when those targets hit. And judging by how many of you dealt with the latest pullback, volatility isn't something many of you handle very well. But the fact is, and this applies to investing in anything, if you can't handle the volatility, you might not stick around long enough to reap the rewards. Now, a quick word on buying gold and silver before we get to this video's viewer question. If I think at some point in the midterm, gold and silver will pull back before heading up again, why the heck am I still buying at these levels? And it's a great question that deserves an answer that I'm anticipating many of you are probably thinking in the back of your head. Because I put out an alert on Thursday on my Patreon saying I was buying the $2,470 pullback level on gold. And by the way, if you're interested in joining my Patreon, the link to do so is in the description and pinned comment. I've got lots of extra videos, price targets, newsletters there. I think it's something many of you would be interested in. It doesn't cost too much, by the way, and it supports me, again, staying full-time here on YouTube. But getting back to the main topic, I bought that level because of this story, because I immediately recognized what this story, what 818,000 jobs disappearing actually meant. And what it means is that the Fed may be more aggressive in its rate cutting in 2024 than I had previously anticipated. It also means we may see gains for gold are higher than my current estimates, much like we saw in 2007 following the July rate cuts. And when I factor in all the geopolitical tensions that exist right now that didn't exist back in 2007 and 2008, I simply think it's too risky to stop stacking here, especially when I think that the downside risk is only about 20% on gold. So for that reason, instead of pausing my purchases, I have decided to stay on a schedule, but at least for now, with the price above $2,500 an ounce, I will keep my purchases to fractional gold and see how the market evolves from here. And when it comes to silver, and I'm sure that many of you are wondering how it is I'm also approaching silver right now, since I bought the last dip quite aggressively, and anybody who is, again, a member of my Patreon will have seen my different price alerts there, I am simply pausing my purchases for now. I feel like I adequately stocked up on this last pullback. So again, for those of you who are wondering how I'm approaching the topic of silver right now, that is how I'm doing it. Okay, so with that said, it's now time to move on to this video's viewer question. But first, I'd like to ask you all to let me know what you thought about my gold and silver scenarios that I presented in this video in the comments section below. So please drop a comment there or even a question that I might answer in a future video. Don't be shy, I read them all. So getting to this video's viewer question. This week's question comes from Two Brothers Stacking. Hello, two brothers. Hey guys, how's it going? I would suppose this is two people. And the brothers want to know what I think will happen when central banks become net sellers of gold. And I love this question, especially in a video where I'm talking about the potential pullbacks we could see on the prices of gold and silver, because it wasn't all that long ago that central banks were selling their gold. And let me tell you, it was, although a minor blip in time, it wasn't a good time for people who were looking to protect the value of their hard-earned wages with gold. And that's because the trend of central banks selling their gold was confirmed in 1989, which just so happens to be the year it was becoming very apparent that the Soviet Union was about to collapse. And although it didn't happen until 2 years later, in December 1991 to be exact, central banks around the world were ready to fully embrace the petrodollar as the long-term replacement for gold, because this event projected the strength of the United States as the leaders of the civilized world, and central banks were eager to organize themselves around that. As a result of this central bank selling, the price of gold measured in US dollars fell 38% from the average closing price of $437 in 1988 to $271 in 2001, before gold started to reverse that trend in the wake of the dot-com bubble, when investor interest in safe haven assets was somewhat renewed and met with the launch of an ETF in 2004, but that's a topic for a different video. Now, when we look at gold holistically during this period, although it lost 38% of its US dollar value from, again, 1988 into 2001, we still have to tack on an additional 46% inflation to that bill, as well as account for the opportunity cost of being out of the S&P 500 during one of America's most prosperous economic times, which delivered a 348% return on investment over that period, not including dividends. So, stacking brothers, this is what the world looks like when central banks are dumping their gold on the market. But with that said, we have to assess the likelihood of that happening, because from my point of view, a very good lesson was learned in 2008 as a result of the global financial crisis. And that lesson was The strength that the United States had projected during the fall of the Soviet Union and the economic boom that followed in the 1990s, which included a surplus along the way, that was something that was not sustainable. It couldn't last forever. And as nice as it was having your central bank reserves parked in US bonds earning a return as opposed to frozen in gold earning nothing, because that is always the argument against gold, right? 2008 proved that the counterparty risk attached to having too much of your reserves in US dollars was simply too high. And that's because from the start of 2007 to the end of 2012, during really probably the most rocky periods of that global financial crisis, the supply of the very reserve assets so many central banks had been conditioned to believe was better than gold grew by almost 50%, as you can see here on this US M2 money supply chart from the Federal Reserve. So flipping back to the central bank buying data, at this point, I think it's safe to say that the secret is out. And as great as getting returns on your reserves can be, nothing can fully replace having some good old-fashioned gold in your vaults. And if we look at the actions being taken by central banks right now, along with the targets some of them are setting to collect as a percentage of their total reserves, for example, Poland is targeting to have 20% of its total reserves in gold, we can expect more central bank buying moving forward, not less. And this is precisely why, even though I am scaling my purchases down a bit by moving to fractional gold, for the time being at least, that may change at some point moving forward, it's why I haven't totally paused my gold purchasing. Things are unpredictable right now, but in the long term, the success of precious metals, so gold and silver, at least in my opinion, is a pretty good bet. So that's it for this video. I thank you all for taking the time to watch. Please remember to leave a like if you enjoyed this content. Please remember to leave me a comment, a question, and if you really think this content is important and that more people should see it, please share this with your friends and family to let them know what is happening on the market so they can have themselves prepared as well. So, as I always say in all of my videos, take care of yourselves and take care of each other. See you all in the next one, everybody. Goodbye.